In this presentation, we will take a look at a horizontal type of analysis for financial statements. We're going to have the data on the left-hand side. We're going to enter that data into the blue area on the right-hand side. The data consists of the financial statements, including the comparative balance sheet for the current year and a prior year to that, and then the comparative income statement for the current year and the prior year to that. We're then going to take that data and we are going to create a horizontal type of analysis with a dollar change and then a percentage change. So this is going to be one of the common types of techniques that we're going to have when we analyze data, to have this horizontal type of analysis. Horizontal, and then you want to think of a vertical analysis type. We're considering here the horizontal, which will typically be comparing year to year of the same company typically. So we're going to have, in this case, of course, the current year and the prior year. We want to be comparing those two periods. Also note that we got the current year up front. That's often the case because when we read it from left to right, we're basically picking up the most important data. Now, you might think that it would be the other way around intuitively, because you might think, well, I should be reading, the first part of the story to the end of the story, which means year one and then year two. But obviously, when we look at the financial statements, most people don't have a lot of time and they don't want to read the whole story. They want to see the most relevant data first. And that's going to be the current year, and then we'll compare that to the prior year. So just be aware of that as typical type of standard. Doesn't have to be that way, but often you'll see it that way. So just note which year is being represented. Often the current year will be first. And then we're going to take the dollar change. So we're going to consider the dollar change and then the percentage change. As we do this, we want to be able to make a comparison and see the dollar change, see it for what it is and what it can do for us and what it can't. And then consider why the percentage change is necessary. The percentage change is something that most people aren't as comfortable with ratios, but ratios are really going to be important when we start comparing data. So we really have to get comfortable with ratios, and hopefully as we go through the ratio analysis, we'll get an idea as to why that could be. So actually I'm going to go down here to the income statement first, because the income statement is the performance type statement. So when we're thinking of how the company did over a time period, we're typically looking at the income statement, and therefore when we look at performance, which is what we're basically often doing with the ratio type of analysis, we often consider the income statement, the performance statement, the timing statement. So let's consider this in terms of the dollar change. So we're going to say the dollar change is the prior year data minus the current year data. There's the dollar change. Then we want the percentage change. Now the percentage change allows us to compare it to possibly other companies that have if we looked at the other company and looked at their percentage change year over year, even if they had completely different numbers in terms of full dollar amounts, we can do a percentage change analysis and get some information, some relevant data from that. Whereas this dollar change of 13,595, if we're talking about another company that's much larger or much smaller than us, isn't going to basically help us. It's not going to allow us to make a comparison with another company. So these percentages really important. The way we're going to do this is we're going to say this equals the prior, or the changed amount. That's going to be the numerator, and then the denominator is going to be the prior year, where we started from. And that's usually the confusing point. So we got the dollar change over the prior year information. That's going to be the 6.3. Obviously it's formatted in this case in terms of a percentage. Okay, so we'll do that here again. We'll say this is equal to the current year minus the prior year. That gives us the change. And note that this change that we're calculating over here, the percent change, we're saying this went up by 6.3%. That's going to be something that you'll see oftentimes in many different types of statistics. So it's relevant not just to financial accounting. If you do any kind of sports statistics and things like that, you'll often see this kind of percentage type of change. It's the only way to measure two people. If you're measuring performance between two people who had different things like at-bats or time of play or something like that, you got to use a ratio. It's the only way to really make that happen. So, and the way we're going to calculate that, the percentage change is going to be equal to the dollar change, the change in actual amount, whatever we're talking about, batting, at-bats or hits or whatever. And then we're going to divide by the prior year amount, not the current year amount. And that'll say, okay, it went up 7.4%. Went up 7.4%. We can compare that 7.4% increase to another company who has completely different dollar amounts. And so that's going to be the usefulness of this. So let's keep on going through this. The gross margin is going to be the prior or the current year minus the prior year. And then the percentage change is going to be equal to the dollar change divided by the prior year. And then we're going to say research and development is going to be the prior year minus the current year. The current year minus the prior year. And then we're going to say the percentage change equals the dollar change divided by the prior year. And then we're going to take this again, we're going to say it's going to be the current year minus the prior year. And then the percent change is the dollar change divided by the prior year. And of course, we can just keep going through this all the way down. We're going to say this is going to be the current year minus the prior year. And then we're going to take the percent change is going to be the dollar change divided by the prior year. Now, obviously, we can use the autofill to do this type of calculation within Excel much easier. So once you get the concept down, then you're going to say, okay, how can we do this a bit quicker? Well, I'm going to delete all of this and just autofill this. Both of these, as I pull this down, should pull down exactly the way we want it. The same with the percentage change. Both of those cells should pull down and the related references should work. So I'm going to highlight or select these two cells, put our cursor on the autofill handle, left click and drag down, and we'll autofill all the way down as we go. And now we could just basically check a couple of these. We could say, all right, let's take a look at a couple of these and see if it does what we would expect. And it looks like it is doing what we would expect on it. So there we have this. All right, and now we can basically go through this and we could put in a standard and say, okay, which one of these do we want to take a look at? We might put in an arbitrary standard and say, hey, anything that's over a percentage change of possibly 10% is a relevant change from year over year and therefore something that we should look into. So under that condition, we might say, net sales is pretty within the range, gross profits within the range, research and development is different, 15.3% increase. And we might look into that and say, well, we need to explain this one because it's a little outside what we would think of as the normal range. Obviously, research and development went up. What are the reasons research and development went up in this year? We might do the same for the total operating expenses. Why did they go up? Well, one of the primary things that went up with it was, of course, the research and development, and we can basically go through analysis on that. We can then take a look at the other income, which went up 103%. So we could say, well, what's in this other income category? Why did it increase by such an increased amount? We'd have to dig into that and say, well, what's included in the other income? We might say that income before taxes is relatively constant. And then the income taxes here, and then the net income relatively constant in the earnings per share. Now let's do that. Now the income statement is once again going to be that performance type statement. So you would think year over year, this is the one that you kind of be concentrated on to see if it's within that relevant range, because this is it's supposed to show how we're doing over time. This is the performance, the timing accounts. When we go up to the balance sheet, we'll do a similar analysis, but just remember, of course, the balance sheet is as of a point in time. It's not going to be a timing type of statement. So as we consider the ratios, we need to keep that in perspective. We're looking at a point in time. We're looking at the prior year as of the end of the prior year and as of the end of the current year. So keeping that in mind, we'll take a look at cash. We're going to say the $20,289 minus the $20,484. And then we'll take the equal to the change divided by the prior year. And that gives us a 1% change. So it went down by 1%. So we're going to do this again. We're going to say the current year minus the prior year. And then the change is going to be equal to the dollar change divided by the prior year. And then the accounts receivable is going to be equal to the current year minus the prior year. The change will then be equal to the dollar change divided by the prior year. And then we'll take a look at accounts receivable is going to be the current year minus the prior year. And then we're going to take the percent change, which is the dollar change divided by the prior year. And then we'll take the other receivables is the current year minus the prior year. And now Excel's starting to calculate the percent change for us. We can see here that it's going to be the same calculation all the way down. So the actual Excel will, of course, make this much easier for us. I'm going to delete all of this and we'll just autofill this down. So we'll select these two cells that we have formats in there already. Put our cursor in the autofill handle, left click on it, hold down, and scroll all the way down till we get to the end of this, and that'll actually apply the same formulas all the way through. Obviously we're going to have to go back through here and see a couple cells that don't work. Obviously this is a subtotal. We'll just delete that. We're going to go back up. This is going to be a category. So we'll delete that, go back up. Everything else looks good. And then we can go through our same type of analysis, and remembering that these aren't performance accounts, but if we see a significant change in the balance sheet, we're going to ask the same questions. And we're going to say, well, why did that happen? This is going to be our general type of technique. We're going to say, all right, that looks pretty good. This is over a 10% change. And we might have a different kind of set of standards. 10% is a random, an arbitrary number. We might set the number and say, this is the type of number we want to look at. But note that we can't necessarily simply look at the dollar amount, because the dollar amount is going to be much different depending on the account that we're considering. So if we take a look at a percentage change, we can apply that to more accounts than we could a dollar amount. So we can go down here and say, okay, short-term investments changed 15%. That's fairly high. We can say, okay, why did we put more into the short-term investments? What's going on there? And then we can basically write down and log down that information. We could say, okay, accounts receivable over the 10%. We can basically consider what's the reason accounts receivable is a little bit higher. Inventories is substantially higher on the 127. So we have a lot more inventory on hand. So we can consider, why is it the case that we have more inventory? Are we purchasing too much, or do we have some other strategy that's happening that we're basically holding on to more inventory? And then the other receivables, we can consider what the other receivables are. Other current assets, again, significant change, we can consider in a percentage basis. We can consider what that is as well. Then we look at the total current assets, and of course, it can be explained by the combination of some of these changes up top. And then the long-term market securities, we can take a look at property, plant, and equipment. Were there any purchases on property, plant, and equipment, or what were the purchases for property, plant, and equipment? And then we have the intangible assets substantially lower, which is, so we can consider, why would that be? Why would the intangible assets be lower? And as we consider these, we would write these down, and basically it doesn't mean that a significant change is wrong, but it could be an indication that we're going to take a look at it and basically log down what is happening, what's that change due to. And then we could take a look at the non-current assets. The accounts payable is substantially higher, so we have more payables. Are we not paying off as much as we used to? Are we holding on to the payables more? Is that a strategy that we have, or is that just, why would that be? We got the accrued expenses, deferred revenue, other current liabilities, again substantially higher on the other current liabilities. So we could we'd have to break down what are the other current liabilities that are being included. Why is it higher by the 47%, and basically log that down in our analysis. Current portion of long-term debt, again, substantially higher. So are we taking on more debt, and the current, is more of it current versus long-term? Should we be putting more of it into long-term possibly? Deferred revenue, non-current. Long-term debt also went up, so you would think that these two would be related. The current and long-term debt both went up, so it looks like we took on another loan, and we want to log that down and say, yeah, those are going to be higher because we basically took out a loan. And then we have the common stock, a 14% increase. So it looks like more investment, or we sold more stock possibly. We'd have to basically log that down. And accumulated other comprehensive income. We could basically take a look at that and say, we'll consider what is included there, the dollar amount. We could consider the dollar amount here, of course, as we look at these ratios as well. If something went from 0 to something, or 1 to 10, it's going to have a substantial change from a percentage basis. But obviously the percentage basis is talking about a change in a dollar amount that's immaterial. So we have to, when you consider these ratios, of course, it's not perfect. These are all kind of estimates. We're looking at the data and we're trying to say, how can we compile this data so that we could put up general rules to get a picture of what's happening and look into the things that are most important. And as we do ratios, we also have to consider when those ratios don't work, or aren't effective, or might lead us down a track that's going to be not the best use of our time. And if we're talking about a ratio that has a 100% change for an account that's went from 0 to $100, that's not probably where we're going to need to spend a whole lot of our time, because obviously from a dollar per standpoint on materiality wise, it may not be the most material thing to be spending our time on, given the fact from a dollar amount, even though from a percentage change, it could be high. But note what the percentage change does do for us. It allows us to look at accounts that do have different dollar amounts and put in an average kind of rule, such as we're going to look at every account over a certain amount and consider and log down, write down, dig into what the change is. So we have to consider all the kind of components of our type of analysis and think of where the weaknesses are, where the strengths are, and then consider how best to move forward with them.